Hi everyone, it's Alex here at Session Capital Research. Apologies for the slight delay in starting today. It's Thursday the 27th of June, currently around 4:20 Eastern for the benefit of the tape. Okay, so today a couple of topics to run through. I want to go through the short-term charts on the equity indices. So we'll look at the S&P, NASDAQ, Dow, and the Russell just to see where they stand in the short term. We had an important earnings print yesterday. Micron, DRAM business, other forms of memory too, but primarily DRAM business. So we'll take a look at that. We had a couple of requests in chat for particular topics to look at. So trade desk TTD was one of them, so we'll do that. And then Paloma asked about the XLI ETF versus the DIA ETF. So we'll take a look at those. As always, we'll do live Q&A all the way through. I'll switch mics on in a minute. And as always, very much welcome questions, points, comments, anything. If you're a regular here, you'll know that these sessions are always better when there's questions, comments, all of that, and we can work through the issues between us. So if there's anything you have to ask, point out, criticize, observe, contribute, anything at all, these sessions are much better for it. So do ask away. Once mics are open, you can reach out either by opening your own mic and shouting into the system, or you can use the questions or the comments platform within the webinar software, or alternatively, you can type into the Seeking Alpha chat room, and I can see the question there and read it out for others' benefit. So before we do any of that, let's do our disclaimer, which is on your screen right now, and then we'll get started. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so back to our agenda, and let's get those mics switched on right now. Second. Okay, mics are on. Okay, so let's do short-term equity indices. Let's get these on your screen right now. Now, reason to focus on short term is we've done a lot. The long term hasn't changed much. We're still pretty much at the top of the base case in the S&P and the NASDAQ. Probably going to push on to the bull case, I would say, probably. But let's look shorter term, which is where the action is right now. So let's start by looking at the S&P. This is a really simple chart here. This is ES futures and just 1 second. ES futures with an adjustment made for smoothing out contract date changes. And this chart starts, it's a daily chart from the 13th of March last year, 2023. And the reason it starts there is it's a really convenient sort of launching point of this current bull market. So if you think that the September 22 to November 22, those sort of spike lows, if you think they were just sounding rockets, basically to see if there are any more sellers down here. But the real floor of the bear market on the S&P was around 4,100 on the index-ish, so 410-ish on SPY. And so the launch point was tested multiple times, and right here, 13th of March is when it finally took off. So we get this wave one up from the 14th of March, again 2023, up to the 27th of July 23, a big move, 41.10 to 48.67. July, to October was a really, pretty tough sell-off, because if you'd become bullish late on, and pretty quickly you're out of the money, and you would have been worried that things were heading back to a bear market. Now, this was just a joke, of course, designed to part people from their money, because what happened was there was a pullback, a wave 2 pullback, that finished between the 61.8 and the 78.6 retrace of that March to July move up. And then the S&P mooned and hasn't really looked back ever since. So this is the October 23 low. Here we have a brief high 1st of April, and then a sell-off down to the 19th. A material sell-off for sure. So that was 5,400 down to 5025, material pullback. And then a renewed push up from this April 19th low to the all-time high struck on the 20th of June, so a week ago today. And if you look at the level here, it's a 1.618 extension, which is to say you take that prior wave 1 here, you take the share price change here or value change here, you multiply it by 1.618 and you add it to the value at the wave 2 low here. And the reason to highlight it is because that's a technically important level. People watch 1.618 extensions, institutions trade to it. And you can see that because look, zoom right in. You can see that this level here, where the line is trying to hold a support. And if it does, then that's a really bullish sign for the S&P. It's a silly thing to zoom in on, focusing on as if any one thing matters, but these things do matter technically, which is to say they are trading levels that institutions will defend or surrender according to their proclivities. And so if this 1.618 extension holds, then I think we can see the S&P move up maybe to the 200% extension, which will be another 300 points on the index, or on the futures. So this is probably the most important chart in equities right now, because where the S&P goes, in the end, the NASDAQ and everything else will follow. The NASDAQ will follow with more gusto and the Dow with less. So this is the chart I'm watching most closely at the moment. So basically 55.18 on the futures. Does that hold or does that fail? If we look at the NASDAQ...
Alex, what would happen if you measured it from the September 22 low? What would be the extension of that of the current level?
Yeah, that's a good question. Hang on, I don't know. Hold on one second. Let's clean this up. So let's go. If we're going to do that, we should go from the spike low in October. Do you agree?
Sorry, yes.
Okay. All right. So let's have a look. So where's our wave 2? Okay. So I think I would look at it like this. I think I would say there's your trade point 0. There's the top of a wave 1 there. It's, and if you were to break that wave up, you'd say that was a 3 top there, 4, 5. You'd say that's a large degree 2. I think it's a 61.8 retrace. And let's look at where your wave 3 would be. So right now, if you think that's a continuous wave 3, which I suspect it is, because that's not big enough to be a wave 3 high, You could argue that is maybe, but that's not much of a wave 4. So I think we're still in a wave 3. So I think how this would look is like that. So I think you would say we're approaching the 2.236 extension, I think. And you would say probably that if it pushed through that 56.30 level, then the next stop would be 58.90. And that, I could believe that, to be honest, because we're in a very powerful bull market right now. So for the S&P to put in a 2.618 wave 3 extension, I mean, that's a big extension for the index, but that sort of fit the times, I think. So I think that's the answer. So if you go from the spike low, the bear market spike low, you're probably approaching a 2.236 wave 3. So 56.30 would be a key level to watch. And if it pushes through that, you'd be looking for 58.90. I mean, as you can see, that there's no hard science with these patterns. You're always looking for, well, what's a sensible start point? And if you go from that start point, what's a level to push through? So as long as you, in my experience, follow some of the rules and principles of the chart method, you can generally find sensible support and resistance levels, because this is a language that large account investors use. It's not some wacky mystical analysis method. This is how large accounts actually trade. And so as long as you apply the template to a sensible start point, you can generally use it effectively to go, well, does this price here matter? So for instance, these prices here on the way up didn't matter because they were between key technical levels. Here on this chart, the S&P overshot the 1.618 extension, thought about it, came back below, tried to break back up above, succeeded, and pushed on up through a bull market. But that, you can see that you can see that's that right there is a sort of a conflict zone between bull and bears. And that's because of that 1.618 extension. So although if you start at different points in time, you get different levels, if you like, any sensible application of the method will give you price levels that matter, that can help you decide, well, are we still in a bull trend or have we returned to a bear trend? So if, for instance, 56.30 was rejected and the S&P heads down, then you'd say, well, you know what? It's been a good run. It's been a big wave 3 because the 2.236 is a big wave 3. We're probably in a wave 4 down. Where's the worst it could reasonably go? The worst it could reasonably go would be 4,500, retest of that wave 1 high. Probably it won't go that deep. Probably it will go to something like the 38.2 retrace, maybe the 50% retrace. So if we said 5,000-ish for the want of a better round number, and then a wave 5 higher. So
that's always worthwhile watching you do it on the fly to see what questions you're asking yourself. Thank you.
Yeah, I mean, it's so I never get too hung up on, well, there's no sort of Olympus point from which to measure. It's always a question of interpretation. But how you know if you're sort of following the money correctly is, can you find the conflict zone between bull and bear? So that where that purple circle is, that's a conflict zone where it's shot over, rolled back over to the downside, had a go at the upside, failed once, you can see with a big red candle there, tried again and succeeded. So as long as you can find those zones, you can give yourself sensible signposts to go, is it still bullish or is it bearish? Is it still bullish? Is it bearish? So for now, that looks bullish to me. If it failed to beat 56.30, as in it tried a couple of times and it rolled over and sold up, or it shot up over but then came back down again, then I'd think, okay, short-term bear trend. That's what I would think. Okay, hope that helps. Right, NASDAQ. Let's have a look at this one. Now, rather unusually, NASDAQ looks a bit scruffier, I would say, at the moment than the S&P, and that's probably because there's something of weakness in semiconductors. I'm not sure that's a long-lived weakness, but for the moment anyway. Now, this chart here does not adjust for changes in contract date, so it's slightly different lens to the S&P, but we can still use the chart. The question here, I think, is, well, has the NASDAQ finished correcting? Was this Monday the low? And are we moving up again, or is there a C leg down to come? And of course, we don't know the answer to that. But if you said that, if you wanted to be protective, you would say, well, look, the A leg sell-off here wasn't very much. It was from 23.84 on the futures down to what, 19.732, so 600 points. If this B wave, if it is a B wave and not a resumption of a bull trend, if you deducted 600 points from the top of that B wave, that would give you your A equals C condition. I'm going to say it's around there-ish. So what's that? 21.59. Yeah, that'll do. So if you said, an A equals C, which would be around there, is a likely correction. If one happens, you might get a C equals 1.618A if you're down here, which would correspond to that wave 3 high. So if the NASDAQ is going to sell off, it's probably not going to commit grievous acts of self-harm. It's probably going to just sell off a bit. And if it does, probably it'll go down to, I don't know, 90,000 or something. So whilst you can, if that happens, you will see screaming in the street, and anyone who owns, short-dated calls will be crying, but it's not that much of a correction. So again, how I would look at this to decide where are we is, if price breaks up and over the high made intraday on the 20th of June, I would think that's probably not a B wave. That's probably a resumption of a bull trend. Now, B waves, as I say often, can break up over that prior high, but not often. That's unusual. So if we get a movement up to here, my guess would be that's not a B wave. That was just a short-term correction, and we're moving up off again. That would be my take on that. I think the NASDAQ is a little bit uncertain at the moment because it's not obvious whether semiconductors are just going to pick up a bid again, or whether there's just going to be a sustained period of sideways or weakness as money comes out of semiconductor and into things like enterprise software, which you've seen in the last few days has started to really run up. And obviously, I don't know the answer to that. So, a bit hesitant on the NASDAQ at the moment. I'm confident of a longer term trend up, but the next few days, couple of weeks, not sure. Seasonally, you would expect the NASDAQ to be strong into July, and then probably a sell-off in Q3, and then probably a move up in Q4 is the seasonal trend. So the thing I would be looking for is if the NASDAQ does move up, then by week 2 July, if it's moving up, then I'd be getting ready for a sell-off into September, October, something like that, which it did last year. And if one was unprepared for that last year, it was pretty painful. If you're prepared for it and you'd either taken profits or you hedged, then it's okay. So that's my take on the NASDAQ. If we do the Dow, the Dow's looking strong. So this is the chart from the April 19th low. Wave 1 up here. Wave 2 down, 78.6 retrace. And I think we're in this wave 3 up now. So we've had 1, 2, 3, 4. I think we're in a sort of a wave 5 of wave 3, if you like. So I don't see anything bearish about this one. It's common for the Dow and the Russell to run ahead of the S&P and the NASDAQ. So I'm happy that they're not, if you like, reconciled charts. They're separate instruments, separate animals. So I'm pretty bullish on the Dow. And then the Russell, same story really, which is here's the low, April 19th, wave 1 up, 61.8, wave 2 down, and I think we're early in a wave 3 up. So I feel pretty good about the Russell as well. As always, if you want to zoom out as a sense check on the Russell, very easy sense check, is IWM over 200 or not? If no, worry. If yes, and 200 holding a support, then that's pretty bullish in my view. So that's my take on indices, which is to say, S&P looks good, looks constructive, looks bullish, but it's sat around, one or two key levels, and so it's got to keep pushing up, because if it starts to go sideways, then it can go. If it starts to go down a bit, then we might see a short-term correction starting a bit early in the year. Nasdaq. I think Nasdaq comes down to what happens to semiconductors. Do they hold their level now? Do they drop? Do they move up? What happens to semiconductors will determine the immediate direction of the Nasdaq, just because it's such a heavy weighting in the Nasdaq at the moment. Dow looks bullish to me. Russell looks bullish to me, subject to that IWM 200 line in the sand. So that's my take on indices. There was someone's hand up. 1 second. Preston, you have a question?
Yeah, hey Alex,
Hey.
appreciate it. On the S&P, sounds like, I mean, if it does keep pushing up, it sounds like from that sort of medium scale time frame we looked at, you would anticipate a wave forward down somewhere along the way if we are in the bullish case on the larger degree, maybe prior to kind of that bull top. In other words, I guess does the wave 5 top on the S&P that we've been looking at sort of coincide with your 3 on the larger degree?
No.
Okay.
No. That's further ahead. So
Okay. Got it.
I mean, this is the bull case for SPY here, SPY. So my guess is that, I mean, right now, could you be really confident that SPY was going to hit 766? No, it's too far away to. I mean, it might do, but it's too far away to sort of have confidence in that. Do I think it could hit 607? Yeah, I do actually. So that's another 10% up or something. That doesn't seem so hard to do. It could be that 607 proves to be real resistance. Now, the argument against that is, well, it's only the 100% extension of this wave 1 which runs up from the COVID lows. So sometimes wave 3s are the same length as wave 1. That's what 100% extension means, but not often. They're usually longer. So I'd be looking at around 600 on SPY. I'd be saying, well, have we got real momentum pushing up or not? On a pure technicals basis, you would say it's more likely that it hits 766. It's just that, try as I might, I can't help but look out the window and sometimes glance at the news and all those things, and you think, well, can it really? Is there really enough juice to add, another 40% or something to the S&P? So sorry, another nearly 40%. I don't know. Technically, that's a much more likely outcome than topping out at 600. But if you just look around at the world, and you would say, well, is that the world we're in? Are we going to see that sort of move up? And it's hard to reconcile this bullish of a chart with what you see out the window. Now, I have learned, I will say, to stop looking out the window as regards stock prices, because it doesn't really matter. What you see in the stock chart is like having a little time machine sat outside your window, a little lens on the window, so that when you look through it, you're not looking at today, you're looking at a few months' time. So a bullish chart, in my experience, tends to portend good things happening in the world, and that's the order in which to look at it: chart first, world second. But being human, it's hard to ignore the real world sometimes. So again, I'm not sure I could look anyone in the eye at the moment and say, SPY is going to hit 760 before it rolls over. So longer term, I'm pretty confident of another 10% up in the SPY before any problems. Shorter term, I think the thing that I'm concerned to not mess up personally is there's usually a Q3 sell-off. And I got caught a bit on the back foot by this last year, particularly in the Russell. So I had too big of a position in the Russell in July, and it sold off harder than I expected. And so, I mean, it worked out okay because I sort of scalped some short positions on the Russell on the way down, but not in enough size and not often enough. So I made some money from the sell-off. But what I had to do was, when my long Russell position was all beaten up in October, put a lot more capital into the Russell than I would normally do because it's such a volatile index. I sort of grit my teeth to ride it up, and it worked out. It worked out fine, very, very, very well actually. But it wasn't enjoyable at all. And so I don't want to repeat that experience. I want to be ready for any kind of Q3 sell-off. Equally, I don't want to anticipate it and hedge or take profits before it starts, because then that's just leaving money on the table. But I personally am a bit antsy at the moment. I'm a bit sort of itchy about, well, I think that's going to happen. It might happen early because there's been such a massive run-up in the last month or two. I'm a bit twitchy about what semiconductors are going to do to the NASDAQ. I can see that they might find support. On the other hand, software is awfully strong at the moment, so perhaps that's a lot of money rotating into software. So I'm personally just a bit short-term twitchy, whilst at the same time being medium-term bullish. That's a really long answer. I hope that's helpful.
Thank you. So that wave 4 down would kind of coincide with the potential week.
Yeah, I think so.
On the time frame, yeah.
Yeah, I think so. And they don't look much on a chart a way forward like that. But if you have sizable positions, and particularly if you have leverage positions, and it's all working against you and you haven't hedged, well, that's brutal. So you do need to know if and when they're happening. So I'm sort of sat here a bit, over caffeinated, waiting for that.
Right, and even if it pushed up to the next level, still pretty good chance that 4 would come at some point.
Yeah, I mean, the thing is, it's coming.
Yeah.
And if it goes up to the next level, then all is, well, the 4 is going to be deeper.
Right.
Because all movements in this technical system, all movements are relative to the last movement. So a 38.2% drop of a bigger wave 3 is a bigger drop, so it's going to feel more of a brutal correction at the time. So I mean, yeah. So if I had to guess and pin my colours to the master, I would say we probably have another couple of weeks of strength, best guess, and then I think we're going to start to see some weakness into Q3, and then what I hope I catch is to hedge your net short at the right time, and then October, November will almost certainly turn bullish, and then I hope I correctly call that, sell the hedges and shorts, and then pile on the longs again. That's sort of that's the pattern I'm expecting. Yeah, we'll see if it happens.
Yep. Thank you.
All right, good question. Thank you. Any other questions on indices, folks, before we go on to Micron? Okay, let me just check chat room so if anyone's in there. No. Okay. Okay, so let's look at Micron.
Hi, Alex.
Oh, hey.
This is Abhishek. I have one question.
Hey, Abhi. Yeah.
So, according to this chart, we might see some weakness in Q3 of this year. How do you relate that with if someone wants to handle their position in single name stocks? Would it be wise to look at the individual stock names, their charts? I think that would be the right way to do it. But I'm just trying to understand, how do I link this index performance with my individual stock holdings?
I think you're right, Abby. I think you take it stock by stock. Because I mean, if you look right now, the S&P is sort of flat in the last few days, but semiconductors have been hit somewhat, and software is up quite a lot, and you can't see that from the index. So if you had a portfolio of only software, you'd be going, yeah, this is just brilliant. It's just you know, it's all major religious festivals in one in the last 3 days. Brilliant. Whereas if you only own semiconductors and leverage semiconductors, you'd be thinking, oops, this isn't enjoyable. So I think you're right. I think go by each individual stock. Yeah.
Thank you.
If I think back to last year, then I don't remember. I'm only going by memory here. I don't remember any particularly painful major single stock damage. I do remember getting all bent out of shape by a too big TNA position that I didn't hedge properly, and so I had to sort of scalp TZAs on the way down, but again, I didn't do it aggressively enough. So I took various pieces of short profit. That was good, but my TNA position got absolutely beaten out of shape, and I had to really hard average down with a lot more money than I would like to have in the Russell in October, November. So the thing that hurt me last year, and getting worked out in the end, was too big of a position in a leveraged ETF in a weak index during a seasonal correction. Apart from that, it was brilliant. And it worked out fine, more than fine, but it just took a lot of scrabbling. And October, in particular, if I recall, wasn't a great time for stomach acid. But that's just my own poor execution. Single name stocks, I don't remember being particularly painful. So again, it's the thing I'm concerned about going into this Q3 is, large levered index positions, and I just don't want to mess those up. Single name stocks I'm not as concerned about. If I own lots of really scary stuff, then I'd probably be a bit more cautious. But I'd be surprised if Apple, Nvidia, all that dived enough to want to sell them as long-term holds. So that's my expectation. But I think you're absolutely right, which is go chart by chart.
Makes sense. Thank you.
Right, good question. Thank you. Okay, let's do Micron. I'm just going to switch the share off for a moment while I get the numbers up. Okay, so let's do Micron earnings printed last night after the bell. For those of you who don't know Micron, it's one of three globally important memory chip businesses. So they produce DRAM memory and NAND, NAND memory. DRAM primarily used in more expensive compute devices, and NAND more often used in cell phones and lower end devices. To be very broad about it, memory chips are something of a commodity, and they move in cycles. It's a horrible business to be in, memory, because you have to be tooled up and ready to produce at any time for a big upswing in demand. To do that, you have to buy, the latest machinery, which costs unimaginable sums of money, and you have to buy a year or two ahead of time. You need wafers to be ordered, vats of chemicals in place, people getting ready to produce, and then all of a sudden demand comes in a rush. And then that demand tails off, and you have to make sure that you're not still putting lots of money into capex and in wafer inventory at that time, otherwise you're going to get absolutely killed. It's a horrible business model. what helps it is there's only three large global providers: SK Hynix, which is a Korean business; Samsung, also Korean; and Micron, which is a US business. So Micron is the only major US DRAM producer. So it has a number of advantages. One, it's a US producer, and the more that the CHIPS Act kicks in, which is basically to say the more American protectionism around semiconductor kicks in, that will help Micron disproportionately. It also has an advantage insofar as it has some high-end, particularly high-performance DRAM chips that it's deemed to be AI devices. It's just memory like anything else, but they're selling it with an AI sticker on it and a big price tag, and it's sold out for a year or something. So you can't trust a business like Micron, by which I mean it's the opposite of owning a subscription software business, which is it swings around all over the place. And very often the best time to buy Micron is when its valuation multiples look preposterous, when you're buying it at a huge multiple of revenue, a huge multiple of its negative cash flow, because that very often is the time for an upswing. Right now, Micron's in quite an unusual position, which is to say it's had a big run up in revenue growth. So, a year ago, the May 23 quarter, negative 57% year-on-year growth, and that's not unusual. You see this. You see this often in Micron. 2019, negative 42%. And then it swung up rapidly to a rate of growth that I don't think I've ever seen with Micron, 82%. No, that's as high as I've seen it since I've watched the company. And growth is accelerating. So we went minus 57, minus 40, plus 16, plus 58, plus 82, and a guide of plus 90 next quarter, which I suspect they'll beat by a touch. So you have a massive acceleration in the business, and that's part of the units, but it's mostly average selling price. So in other words, they are commanding higher prices for their product, and that is a combination of high performance product being shipped and also supply shortages. So this kind of can't last forever. It's a cyclical business, and at some point, their supply of AI branded memory, will match demand, and so pricing will level off and growth will level off. But right now, the thing's on fire. So you have a business making 32% trailing 12-month EBITDA margins, still negative cash flows, but that will probably turn positive next quarter. It's a solid balance sheet. It has some debt, $4 billion of net debt, but it also has very positive EBITDA, and so that's sub 1 times leverage. So there's no concern about debt serviceability there, in my opinion. Obviously, it's a bigger multiple of cash flow because there isn't any cash flow, but most lenders will be looking at EBITDA multiples, not cash flow multiples. And the business generates and has enough cash to service the debt. So I'm not too concerned about the balance sheet. Valuation 7 times revenue. That's not a big number for a company with this level of revenue acceleration and a company of this size. So fundamentals and fundamental valuation look good. The rider here is it's not like NVIDIA. It doesn't have the degree of intellectual property defense that NVIDIA does. And so in my experience with Micron, you kind of can't trust it to not let you down. And so I don't mind owning Micron. I have a very small position. Just 1 unit. I might add to that. I might get to 2 or 3 units. I probably won't get to more because it's a cyclical business and it can let you down badly. If we look at the stock chart, this is the longer term chart, and this shows you that these levels are traded. So hang on, this is a log scale, I think. Hang on, switch log off. Yep, okay. So look, here's the COVID lows, $31 a share. Wave 1 up in the early January 22, $98 a share. So it's basically tripled. Drops down to 78.6 retrace. So there you go. That's institutional signature if ever there was one. Big accumulation zone here between 48 and 72, which is to match these grey high volume nodes here. It breaks out in October last year. And look, it hits exactly, our old friend, the 1.618 extension, and it spikes up, hits that, and finds resistance there. Now the question for me with Micron right now is, if you look, the stock, I'm just going to move that, the stock dropped one Fibonacci level in this wave 3 from its all-time high here, which was last week, down to the low here. So I was watching it around the close today, and it was sort of hovering around 130, 131, and was trying to decide whether it was going to plunge through it or not. And I was sort of thinking about adding another unit at the close, and I decided, well, what's the hurry, because it could drop further, so I'll wait. But if 131 holds as support, then it can push on up to 182, I think. But you just want to see, after a 6-7% sell-off on earnings, well, where does it find support? Because if something bad happens in the market tomorrow, you can imagine this is going to keep selling off. So personally, my view is I think it might hold 131 as support, but I'd like to see a bit more evidence for that. If I see it holding support, I'll add to what's a small position. My biggest exposure to Micron is through SOXL, and so if Micron performs, if the stock starts to move up, so too will Nvidia, I expect, and then SOXL will look after itself. So cautiously optimistic on this. I personally want to see where it finds support before it moves up again. I think that it probably is going to reclaim that all-time high, but it's something about tomorrow. So I'm just it's not a reliable stock, Micron, because because of the nature of the business, it's very cyclical, capex intensive, all those things, and so you really have to catch it right. And if you call it wrong, Micron, it can hurt you. And so I'm just a bit cautious with this one. I do think it can make new highs, but I want to see that either 131 hold as support, or if that falls away, expect 115 to be tested. And then, worst reasonable case, this wave 1 high, 98, could be retested for a deep wave 4 before a wave 5 higher. So my own view on Micron is, medium long-term bullish, short-term, I bought some at the open today after the drop. Happy with that, just one unit. And I'm looking to see where to add. And I don't expect to own, I can't imagine owning more than a 4-unit position, probably more like 2, maybe 3. So that's Micron. Micron is a big part of SOXX, the ETF and SMH. So if Micron drops, it'll probably drag those down with it. If it moves up, it'll probably push up those semiconductor ETFs. So even if you don't own Micron, if you own any chip stocks, you own the chip ETFs, then you want this to find support and move up. So that's Micron. Any questions on that one, folks? Okay. Ross, hey.
Good afternoon, Alex. Actually, this is not a Micron question; it's an Apple question.
Okay, sure.
On AAPB.
Yeah.
I had that too, and I sold earlier today, and I noticed that you had sold because I was just wondering about what's going to happen tomorrow, and I noticed that you had sold a couple of days ago and then bought it again this afternoon, and I was just kind of curious about your line of thinking about that.
Yeah. So I sold it before Micron earnings because I was a bit worried about it, because I thought if Micron bombs, it's going to drag all of tech, including Apple, down with it. And so I had some gains in it, and I just wanted out before the Micron print. So that's why I sold it. And then I bought it again today because, everything is up except semiconductor and except Apple. So, enterprise software is up. Boring on companies like, Salesforce up 4%, Sentinel-1 10%, Datadog 4%, Apple 0.4. So I thought, well, that's a laggard. I think there's a reasonable chance it turns up. And what I like to do with those leveraged single stock ETFs is buy reasonable size positions. So I will probably had 4 units of Apple of AAPB last week before I sold it. And you've just heard me say I don't really want to go beyond 3 units of Micron. So for the single stock levered ETFs, I prefer to apply reasonable chunks of capital, especially if it's Apple, because it's probably not going to fall through the floor, and there's a good chance it goes up. So if I mess up, probably it'll work out. But if I can get small percentage gains on reasonably sized allocations in those ETFs, then that's a worthwhile exercise. So I'll probably do that again with AAPB. But I just thought Apple was lagging today. I mean, I know it's PCE tomorrow, and so that could wreck everything. But if it does, it does. I'll deal with it. But I just thought Apple was lagging today. That's all.
And it seems that some institutional money has been rotating into Apple and Amazon as well.
Yeah, sure. Amazon's on fire.
Yeah. Okay, great. Thanks so much.
Good question. Thank you. I think I've got more. Okay. 2 more questions in chat. Hang on a second. Okay. Abby asks, can we look at the short-term chart of Apple? Yeah. It's not all that informative, I have to say. At least not to me. Okay. I could be wrong, but I suspect we're in a wave 3 up for Apple versus. So this is the January 23 lows. So this, I think this was the Apple. Yeah, there you go. That was the Apple bear market low, January of 23, at 123. Moved up to 200, sold off to 160, a 50% retrace, and I think we're in a wave 3 up now. I don't think we've had a wave 2 of 3 down yet. If you look at it, you can sort of see that one is probably due. So I must admit I had some qualms about AAPB today, because I sort of looked at that and thought, yeah, I wonder if that's going to sell off. It might do soon. But if it does and we're in a wave 3, then there is an inverse of that. ETF will just wait for it to bottom and add in size and go again. So I have a feeling that Apple can run to the mid-high 200s. I think we're in this wave 3. If you look at the sort of angle of attack since that 17th of April low, it's pretty steep. That has a sort of wave 3 feel to it. I think there's a short-term retrace coming at some point. Another move up, but that's my take on the short term. Which is to say, very short term, I could imagine it starting off actually, but over the next few months, I think this is a good one to own personally. I think it's under-owned. I think they'll have a successful iPhone refresh cycle, because you have to buy the new fancy one to get the AI stuff. And I think, as I've said a couple of times now, that if money market rates get cut, then as money market funds return to equities, I think Apple will be a major beneficiary of that. Stock's a bit weak as well, because as you will all know, XLK rebalanced last week, and that meant a lot of selling of Apple, a lot of buying of Nvidia, and so you had quite a lot of supply of Apple stock into the market lately, which I think has just suppressed the stock a bit. So I suspect it can. I think we're in a wave 3 up. I think it can keep moving up, even if there is a week or two sell off. That's my take anyway. Okie dokes. We had a really, really good question from Paloma in chat about looking at XLI versus DIA, and we're not going to have time to deal with it properly. So what I'll do is I'll write a note on that later on. But the very quick comment would be XLI, this is the industrials ETF, has outperformed the Dow, quite considerably outperformed it actually. Let's have a very quick look. It was, I think I'm right in saying, XLI was making new highs. Yeah, there you go. New all-time high for XLI as soon as July 23, and Nasdaq and the S&P certainly weren't doing that. So this is XLI since the COVID lows, 48 up to 108, a very shallow retrace into the bear market lows, very shallow, 38.2 retrace, that's all. And then we're set off on this wave 3 up. The Dow, since the 2020 lows, we look at DIA, similar pattern into the bear market lows, but just hasn't. I mean, look, the Dow made a new all-time high January this year, 6 months after XLI broke up. So XLI has had much more power to the upside, and probably will continue to do that, I think, because I mean, it's not even at the 100% extension of wave one yet. So I think XLI can keep running. Personally, I don't use XLI. I use the Dow, but that's because I can use the U Dow long and the S Dow short for that 3 times levered hedging power, and I can't really do that with XLI. But as a single ETF XLI versus DIA, yeah, probably XLI looks better, I would say. Hope that helps, Paloma. I know you'd be listening to the recording, but if it doesn't help, let me know in chat and we'll go through it in more detail. Okay, any final questions, folks, before we finish up? Okay, but in that case, thank you as always for attending. Great questions as always, much appreciated. A recording will be live in a couple of hours once it's upscaled to HD, and then anything else that you think of that we didn't talk about today that you'd like to cover, just hit me up in chat as always. Thanks everyone. Talk to you all soon.